It's not that the Fed isn't viewing gold. What the Fed, it's not even on their radar.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi, my name is Shane Moran, and I'll be your host for this week's episode of Live from the Vault, the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We have exclusive access to experts and insiders that reveal information and insights that you simply can't get anywhere else. Now, this week we have the one and only Andrew Maguire, precious metals expert and whistleblower in the house. And to help him pull back the curtain, we'll be joined by popular demand from our Live from the Vault community. Thank you so much for recommending industry expert Danielle DiMartino Booth. That's right, Danielle is in the house, and you're not going to want to miss this conversation with Andrew Maguire. And just before we get started here, please keep spreading the word about this channel by hitting that like button, sharing and subscribing. And if you want to be notified in real time as each episode goes live, just click on that bell and we'll do just that. Now, let me tell you a little bit, if you haven't heard of Danielle DiMartino Booth, she's a global thought leader in monetary policy, economics, and finance. And DiMartino Booth founded QI Research in 2015. And she's also the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. And in addition, Danielle is a business speaker. She's a commentator, frequently featured. You may have seen her on CNBC, on Bloomberg, on Fox News, on Fox Business News as well, BNN, Bloomberg, Yahoo Finance, and many, many other outlets. And with that, let's head over to the UK and talking gold with Andrew Maguire and our special guest, Danielle DiMartino Booth. Over to you, Andy.
Hi, Danielle. Thank you so much for returning with us. I know it's been far too long. And, you know, sometimes we get into our own little world here, and it's you know, the gold world, the silver world. And we don't often look out at all of the other pieces of the jigsaw, which actually obviously all interact with what we're trying to make decisions on. So thank you so much for coming. And by crikey, am I looking forward to, getting into a little bit. And, we don't have to talk a lot about gold, but obviously I do want to welcome you to joining us today.
Well, thank you so much for having me back. I'm looking forward to this discussion. You know, the what I call the globality of the recession is I think what's being missed on so many people right now. So I'm happier across the pond because that sews it all together.
Yeah, lovely. And so obviously, can we just start by looking because from our perspective, how the Fed, or should I say, what many of us view as a self-serving cabal of bankers have got, they've got gold wrong. But it really begs the question, Danielle. What I found so interesting is your feedback as a Fed insider in your last visit. You indicated that during your tenure, the Fed never ever discussed gold. It blew my mind that the Fed never really ever discussed gold. But what it kind of suggested was that really they didn't understand gold as an asset class. Anything you want to make comments on that and update us?
I mean, you said you think the Fed's got it wrong on gold. I think that Fed officials would beg to differ because they don't have a view one way or the other on an asset class that simply doesn't exist as far as monetary policy making is concerned. The greatest beast is the credit markets, the monster that they've become, the non-banking financial sector. These are the things that the Fed focuses the most closely on, along with their peers at the ECB, at the Bank of England, at the Bank of Japan. They focus the most closely on the Frankenstein that being too low for too long has created, and how to make sure to not absolutely blow up the financial system because of the vestiges of this. That's why you've seen such a marked change that everybody's in denial about when it comes to central bankers' unified approach to monetary policy. You say higher for longer, and you might as well you might as well have said nothing, because nobody believes it. And yet here we are, and we've been higher for longer. And we are a world that is in denial right now because nothing major has blown up in the credit markets. That's not to say that they're not flashing some serious distress and bankruptcies running at the fastest pace since 2009, things that cannot be dismissed. But that being said, there's not been a Lehman systemic moment yet.
And what's interesting to me, and we'll get off gold in a minute, but what I'm thinking is, how come? I mean, you'd think because on the 1st of January, gold became a Basel III compliant, NSFR compliant first tier asset class. So liquidity providers, whereas they didn't before, are forced to have the physical bullion on hand to deliver. Certainly in the spot markets, not in the COMEX, because we understand it's a cash settled market. So it's exempt in a way. But the wholesale market footprints that we see tell us the Fed is really wrong footed in that respect, because if there's another asset class that's a first year, along with bonds, along with cash, along with other asset risk hedges, what the hell? We see speculators now that were easy to rinse in the COMEX markets. A lot of them are starting to realize, hang on a minute, I have, as part of my suite of hedges, hey, let's put on some paper gold, even though it's not physical gold. So it amazes me that the Fed isn't viewing gold as a first-year asset.
Well, again, it's not that the Fed isn't viewing gold. What the Fed, it's not even on their radar. And I think that's the more important point to make. It's not that I think if you would ask individuals on the Federal Reserve how they view gold as an asset class, they would probably have the same answer. And that is that it is the ultimate safe haven. And that's why their focus is on ensuring the sanctity and the continued safe haven status of the U.S. Treasury bond. Mm-hmm. And because that's the safe haven asset that they view they are protecting. It's in their mandate. There's nothing in their mandate about gold, even though if you want to drill down historically, gold, obviously, sound money policy drives you directly to gold's footsteps. But that's simply not what generations of central bankers have had to add to their intellectual calculus. It simply doesn't exist.
This is so interesting. And I think it's helpful to understand this, because sometimes we think we're puzzling, hang on, these obviously some smart people here. And of course they are. And otherwise they wouldn't be in the positions they are. But it just kind of blows my mind sometimes when you see the Bank of International Settlement at odds with the Fed, having covered all their 500 tons of swaps last year, have gone physically long. Every central bank we look at is openly going long physical gold. And that's on record. And what's off record is the monetary gold, which never has to be reported, is going out in swathes. We see it as wholesalers. We see it. It's on a one-way trip out. And I think that's what amazes me but you've answered the question. It's not on their radar. Hell of it. I mean, it blows my mind, but it's not on their radar. But, you mentioned a minute ago. In fact, you didn't mention it yet, but I heard you talking about, I don't know if you coined the phrase, and I'm pretty sure it probably, it was something about inflation, but you called it, what did you call it? You called it truflation. What is truflation?
So truflation is simply a modern day stab at trying to gauge inflation in real time. So the fact that it's not correlated with a highly lagged indicator, CPI, should not be surprising. But this outfit has been doing this for 2 years now. TRUFLATION. They only track inflation in 2 countries, the UK and the United States. And that, I think, if anything has given credibility to their trying to track 1 billion prices at a time in real time, if anything has given them credibility, it's the fact that their current gauge for inflation in the UK is running somewhere around 13%. That same gauge in the United States is running somewhere around 2.5%. It's identical methodology. And you see through that the intractability, the natural impediments to quickly cutting costs in Great Britain compared to what they are in the United States. You simply, you have more constraints if you're Joe Q, Jane Q, CEO in the United Kingdom compared to to their counterparts in the United States who are able to slash costs much more quickly. So it's a fascinating construct, and it tells you that the Fed is going to go too far, which leads you to believe, what's the greater purpose, right? If you've tamed inflation, and that is not a discussion that you should be having in the United States. By the way, truflation in the UK has gone from 21% plus to 13%. So it is definitely going in the right direction in the UK, and it's been cut by 2/3 in the United States. Has to do with the fact that 90% of the US population lives in a state with rising joblessness. It's pretty simple. You can afford to pay for something if you have a paycheck. If you don't, you're not substituting from beef to chicken. You're just not buying meat at all. That's exactly what the CEO of Tyson Corporation said recently. He said in his entire career, I've been in this industry for 30 some odd years. I've never seen sales of beef, pork, and chicken fall at the same exact time. And that's because Americans simply can't afford to eat the meat, period, no matter what form it's in. And that's when you have people switch the dialogue from, are we in an inflationary or a disinflationary environment, to flat out, are we going to be flirting with deflation? Which is, of course, central bankers' worst nightmare. And of course, anybody who's a gold veteran knows that in such times of financial havoc, that gold well outperforms when you have a serious deflationary environment. There's no threat to gold there. In fact, it holds it up. But when you have these discussions, you begin to appreciate how farcical it is to follow these formal metrics that don't tell you where you are in the real world. And yet, that's, of course, what the Federal Reserve leans on, I think, because they're trying to break markets' symbiotic relationship with monetary policy, such that it's always the financial moneymakers who are making policy as opposed to the Fed making policy.
Interesting. So I think kind of that leads us on to, so obviously we track Powell a lot, and especially, we hang on every word, and obviously it affects gold and silver actually probably more than the other markets. Even just a comment. How is he doing? I mean, in your view, how is he doing? Is he doing a good job?
Well, I mean, when the last time that the credit markets were blowing up like this was kind of when the pandemic hit, you had to roll in with quantitative easing and blowing up the balance sheet and taking interest rates to the zero bound. I would characterize the current Powell as incredibly methodical. He takes policy 1 week, 1 month at a time. The market screams, pivot. He must back down. He must take rates to the zero bound again. He must resume quantitative easing. The world is, as we know it, Armageddon. And 1 week and 1 month at a time, he simply explains, no, I'm sorry, but we will get to 2%. We will get to 2% on the hardest metric on which to get to 2%, which will take the longest amount of time. Until then, I will talk your expectations of my bending 1 week and 1 month at a time. When you think about how long he's been talking like this since March of 2022, successfully, consistently, you have to say, if the goal is to take, if the von Mises acolytes of the world, I'm among them, if you want to take the zombies down one at a time, you do so carefully and methodically without upsetting the financial markets. In fact, a buoyant stock market is your best friend in this environment because it gives you cover to stay higher for longer, something we haven't been accustomed to since Volcker was in the Eccles building. It's been that long.
So having thing is that what's puzzling sometimes is rates have risen at such an accelerated rate from zero essentially to in excess of 5%. Along the way, we've seen a couple of shoes drop. I think perhaps, do you think they even thought about stress testing some of the smaller regional banks and how that would affect depositors thinking, well, if I'm getting like a small 1%, whatever, I'll put my money in a money market fund, get close to 5%. And then what you're doing is draining liquidity. And surely that is threatening the very small banks that have built America. Surely it threatens them.
Well, what's fascinating is that Federal Reserve Governor Michelle Bowman spoke extensively on this subject. And she's very much against simply upping capital requirements, which will further impair the great community banking system that is the fabric of the U.S. economy. She actually advocated for these smaller banks and said the more you penalize the smaller banks, the less they're able to compete with the non-banks that don't have to comply with these. And that's what we've seen. What we've seen since the financial crisis has been a slow bleed from the conventional banking system into the non-banking financial sector. $240 trillion globally is the non-banking sector. $180 trillion globally is the conventional banking sector. One's much larger than the other, but one is completely unregulated. And there's a growing recognition, as well there should be, that not having to play by the same rules is very detrimental to traditional banking as we know it, the banking that you want to have, that somebody walks in the front door in a small town in America and they're extended credit because their family's been doing business with this bank for generations and the banker knows that their money good. And that's how you keep economies and communities vibrant is by having banks understand that the way that a massive private equity or private capital firm is not going to, nor do they want to. They simply want a zero interest rate environment right now so that they can lever up to their eyeballs, put too much debt on company balance sheets, drive them out of business and pay themselves like kings along the way. And that is something that is A, it's morally corrupt, but B, it tears at the long-term productivity of an economy. And I'm pleased to hear national and international regulators finally starting to understand and comprehend who's wearing the pants, because it's not the banks. And this is not just a U.S. phenomenon. If you look at leveraged loans in Europe right now, or the rapid growth of the junk bond market there, these are very young, untested markets that before the crisis, lending was dominated overseas by banks. So it's a new phenomenon, and yet you're seeing how quickly valuations are coming down because of the presence of these non-banks. So look, I wrote a book called Fed Up, why the Federal Reserve is bad for America. But that doesn't mean, and I wrote about the kingpins of private equity in that book. So if reforms are finally implemented, I will be the first to take my hat off to regulators who say we absolutely have to get this source of instability regulated, just level the pitch and move on. It's going to be difficult to do. They've got some of the deepest lobbying pockets in the world. They pay our politicians handsomely to look the other way while they print money. While Steven Schwartzman, CEO of Blackstone, I'm sure he's a lovely person. He made $1.3 billion last year. Why? Because he's in an unregulated entity and he's able to skirt the rules, lever up, securitize, sell off, rape and pillage companies. That needs to stop. And the only thing that will stop it is higher for longer. 1 week, 1 month methodically at a time. Force companies to segue from mark to target to mark to market.
That's really interesting. I've never thought of it that way before. And that makes sense. I didn't realize the size. You're talking about markets here, 180 trillion. I mean, that's massive. That's massive. Unregulated. I mean,
240 trillion unregulated, 180 trillion regulated.
Wow. So, I guess really, what's the next? Because obviously, I don't see any real change. We've had a couple of the big banks go down. We've had some of the regional banks go down, and then I have a lot of friends who look at the markets, and they're saying, you know what, the next shoe to drop, commercial real estate, US. What's your view on that? Is that a shoe to drop yet?
I think it is, and I think it's a global phenomenon. So I don't necessarily even believe that there's going to be grace in other markets where, again, you come in, you see who've provided the backing for these buildings to be purchased, and you'll find a non-bank in many instances. Right now, the smart money is moving out as quickly as they can. What we're seeing in the United States is a very bifurcated market. The A+ properties, the trophy properties, they're selling, and they're selling well. The lowest valued companies, you're just taking the keys and handing them back, giving up the skyscraper. You're just, and it's a growing phenomenon. If somebody who owns a building knows that because their borrowing costs have tripled and their occupancy, even if their occupancy remains the same, let's say you're 99% occupied. If your loan is coming up for refinancing and your borrowing costs have tripled, that occupancy rate is irrelevant. You still can't refinance. So it's at this juncture that we're going to find ourselves faced with refinancing what's in the middle. What's at the highest end, it's going to be money good. What's at the lowest end, you don't even want to deal with it. You don't even want to begin to negotiate because it's not occupied and you can't refinance. But it's what's in the middle. And the unique facet of the United States is that the maturity wall is 2023 and 2024. This isn't something that we can chit chat about because it's years over the horizon. It's now.
And so, I mean, I see Yellen had come out. I mean, I looked back a few weeks ago and she'd come out. She was really trying to soothe the markets when we had these shoes dropping. And I think, I guess so it must affect. I mean, when the Fed is making a policy decision, when Powell is making a policy decision, he must think, it must be part of his factor of thinking to think, well, if I do up another 0.5%, each 0.5% I raise, is it going to escalate this situation, this fallout in the regional banks? Because each time you do that, you're kind of sucking liquidity out of the system. And so surely it must be wouldn't he love to just do what the Bank of England did, raise 0.5% and out of the blue and shock the markets? But what would that do? I mean, that could cause an implosion, surely.
Yeah, well, you know what? Jay Powell doesn't want that latitude. The inflation figures in the UK, they grabbed such huge headlines that there was nothing to be done. You absolutely had to bend. And yet, on Friday, you see data hit one day after this shock 0.5 percentage point rate hike out of the UK. You see from the S&P Global, the PMI for manufacturing and services, you see that the real economy in the UK is weakening at a much faster pace than what you'd had penciled in as an economist. So these types of shock moves aren't necessary once inflation starts to catch up with the underlying fundamentals of the economy. That's already occurred for Jay Powell. So inflation's already coming down at a fast enough pace that nobody's holding his feet to the fire anymore. He's holding himself accountable and saying, until the job is finished, until we get to 2%. Because some would say, well, you've gone to 4% on headline CPI. That's the lowest rate in 2 years. It's if the pandemic didn't occur, for all the damage of pressing 10%. Feels like 5 minutes ago we were talking about that. He said, no. Until the job is done, I'm higher for longer, methodically controlling the narrative 1 week, 1 month at a time.
Yeah, as you say, I never really sort of thought of him in that way.
Well, he's a lawyer, right? He's not an economist, and he's looking at both sides of this, and he's being very strategic in his thinking, and that's innate for lawyers.
So, like pragmatic in a sense. I mean,
Yes.
Yeah. So that's interesting. I have a different view of him now. Now, if I was going to ask you a bit of an outlier question, if Trump got reelected, he's already threatening to take out, really to rejiggle all the three-letter agencies, drain the swamp. Do you think he or the Republicans would try to dissolve the Fed? And if they did, what would be the consequences?
I think that when you see the Supreme Court ruling over and over again against the GOP, you know that some of the hype surrounding some of the more conservative justices was overdone. Remember, we have checks and balances. So it is not an agency that he has the authority to dissolve. And I'm sure that it makes for delicious discussion around 3 a.m. on my Twitter feed. But other than that, it's simply not legal. And the Congress would never let it happen. The Supreme Court would surely never let that happen. So he would be stonewalled. There was a wonderful op-ed that said, don't take away from the fact that Donald Trump cast a very harsh light on China and what the Chinese were doing, infiltrating the U.S. economy, being enemies of U.S. infrastructure. Don't take away from Donald Trump the fact that he moved that spotlight to where it needed to be going forward. Know your friends, know your enemies better. Other than that, and this was an op-ed in the Wall Street Journal, Gerard Cassidy, a good British guy. But he said, other than that, in terms of policy, Trump was completely ineffectual. For all the threats that he made, the swamp got swampier. So, and I think that a lot of us realize that the release of the tapes is probably going to be, one more nail in. I mean, when you hear the tone of his voice giggling about plans to invade Iran, you just say to yourself, this is not a statesman. Doesn't even have a name. So, no, I if there's one person I don't lose sleep over, it's Donald Trump changing policy, because he failed over his first 4 years. He succeeded when it came to China. Yes,
he did. So I guess that kind of brings us on to the other side of your politics in America. It really blows my mind that it is so radically. It is like a hate-love situation. It's almost like
it's
if you're on one side, you hate the other. It's a strange concept, to be honest. Biden. Okay, to be honest, from our side of the pond, he looks very weak. I mean, there's a lot of questions about his mental health, popularity. Is he going to get reelected, do you think? Is it possible? I don't
think either of the two are electable. We forget. We forget that all Biden did was finish the job that Trump started. When Trump was leaving office, he was pounding the table, insisting on $2,000 for that third stimulus check. He's going to deliver. I will deliver socialism in America. Well, all he got was a portion of that, 600. And then Biden's first duty when he got into the White House was finishing Trump's job by paying Americans the balance of $1,400 on the $2,000 promise that Trump had made. So Trump signed socialism into law, good New York Democrat that he was, and then Biden finished the job. Neither of them are fit for office. And the irony is, because so few Americans understand that they basically ran parallel policies to one another, we're going to train Americans to not work by giving them money. Because they ran the same policy, people don't understand how ironic it is that there are even two sides hating each other. There's simply a hollowed out majority in the middle who understand exactly what's happened. We're just not as noisy or ignorant.
Yeah, I mean, it's so interesting because it is. I mean, it shouldn't be, and after all, we're all human beings, and really we're supposed to have a little bit of a higher consciousness than that. I think this is strange to me, but if we saw, I think let's move on to the dollar. I think, as we. And there's no doubt that we are moving from a unipolar world dominated pretty much by the US. And as we move into a multipolar world, does this suggest that the de-dollarizing process, which appears to be underway, will pick up steam? What are your thoughts on that, Danielle?
I mean, the possibility is always there, of course. And, we don't have as many reserves held in dollars as we once did. But of course, $7 trillion changes hands every day in the currency markets. And that is 86% dollars, and really hasn't changed for a very long time, nor has it been diminished or depleted. So I look at the dollar in a very practical way. When Saudi Arabia, which is presented as this massive risk, de-dollarisation, and then they quietly come out in the market and issue billions of dollars in sovereign debt in dollars. I'll believe de-dollarization when I actually see the threats manifest in a move away from the dollar when it comes to actions taken. When you no longer have 86% of global FX everyday trading in dollars, when you no longer have countries threatening the dollar, but still issuing their sovereign debt in dollars, when we move away from that dynamic, because it's so much fun to be an enemy of the dollar, you get such great headlines. You just don't actually want to move away from it in practice, but it sounds fabulous. And you get these lovely headlines. It just doesn't happen in practice. So when it begins to happen in practice, and I'm going off of Bank of International Settlement data, when it begins to happen in practice, I'll get a little bit more convinced. Until then, if anything, the post great financial crisis, the post pandemic world saw an amplification of global debt denominated in dollars. And that's just data. And it makes for the least sexy headlines. People can't stand it when I talk about de-dollarization because they're like, well, that's not fun, Danielle. You won't talk about anything that's fun. And I'm like, I just want to stick to the facts. I don't want to stick to what people talk about in the middle of the night with tinfoil hats on. It's great press. And it sounds great for Xi Jinping to talk about this and the sanctions against Russia and what it's going to do to the dollar, the threat, and the, petrodollars. Who's pulling more oil out of the ground? I ask you. On a practical level, who's no longer dependent on Saudi imports, and therefore OPEC makes these threats, and yet we see Brent crude oil where it is. Again, focus on the data on the ground and pull yourself away from the narrative that others would like to create because they like to rattle their sabers.
Yeah. The other thing I was going to talk about, because this past weekend, there was a very strong potential, and no one knows the full story here, very strong potential that on Monday morning, we could have woken up to a black swan event, which was a military, the Wagner group. If they hadn't gone straight to control, changed, let's just say the nuclear weapons in Russia changed hands. And who's to say that could not have happened? Because it could have happened. And we don't know the full story. There's probably only about a few very close insiders who know what's going on and whether that was actually a ruse to get Wagner into Belarus, or God knows what the real story was. But if it had changed hands, and there's so many black swan events that are factored in. It could be Taiwan. It could be some other Russia information. It could be any number of things that could happen. But unfactored things like this, what would you say to someone? How do you, if you're in the risk markets, what would you do? Would you advise that you should have some sort of hedges in case of a black swan event?
Oh, of course. I mean, there's always tail risk, always tail risk. I think the tails have gotten skinnier post Russian invasion of the Ukraine, mainly because the world has come to the realization with the great Chinese reopening trade that it wasn't so great, that China's finances are not as strong as Xi Jinping would prefer, and that their military allies also not as strong as he would prefer, because the true black swan is Taiwan, has nothing to do with Russia. And I would like to think that the powers that be in the CIA and MIs of the world, they would certainly get a handle on something like that, of that type of threat. But the bigger threat would certainly be world war. And that's when you get down to brass tacks and talk about whether or not China wants it, and whether or not China can afford it. So they have to keep throwing money at their economy, but they don't have as much to throw at their economy as they once did. And if we're using the analogy of the emperor with no clothes, from the time that Putin and Xi Jinping were shaking hands at the Olympics and threatening the world effectively with double invasions, right? Ukraine and Taiwan. That's what it felt like that weekend when they were both publishing their manifestos. From that moment until now, we see two very diminished leaders. And they're diminished militarily because they've been diminished economically. And Russia being in a deep recession, that's something that nobody talks about enough. And that's huge. The fact that the fact that they've lost their biggest clients, and in addition to having to sell their oil at a massive discount, then they have to tack on freight costs because it's no longer conveniently going through a pipeline, but it's got to go in a tanker halfway around the world to India and China. Nobody talks about the implications of the Russian economy being on its knees and China not being able to and or maybe willing to help out their ally as they've come to the realization that their ally is not as strong as they were before, and that they better stick to their knitting and make sure that their own domestic population stays in check.
When we look back at the sanctions that were imposed on Russia, and I'm not making comments as who's right or who's wrong here. Obviously, there's two sides to every discussion. And obviously, we have NATO essentially fighting a proxy war. There's no doubt about it. That's been openly admitted against Russia, using Ukrainian lives. So I think, so forget, not even making comments so much about that. But those sanctions, they really, really hurt Europe way, way more than I think they hurt Russia. And because I'm telling you what happened this past year. Suddenly my electricity bills, gas bills go up by literally, I think we're talking about £500 a month up. The average person, it nailed the average person. So yet US, we're buying US natural liquid LPG gas at much, much higher prices. The pipeline gets blown up, and you kind of wonder whose war is this? Who's the beneficiary of this? Because certainly, Europe, I think, would want a backdoor if they could get it.
And that's that's the shame of how the sanctions were designed and ended up being quite toothless in the end. And then, of course, you have the victims, and there are parallels in the United States because so many small businesses have been sacrificed to the benefit of larger competitors, and it's the smaller businesses in Europe that have unduly, disproportionately suffered because they simply don't have the extra cash flow to go over that bridge. And you're absolutely right. Thank heavens that Germany was able to build tankers on the, ports on the water to take the LNG in and not have to spend years and years making that infrastructure investment in order to have land-based ports. But you're absolutely correct. One of the reasons that one of the ironies of Lagarde ramming Europe into a deep recession. I mean, there's no doubt about it that Germany's in recession. France is teetering. If you look at the PMI data, France is almost as weak as Germany, which nobody wants to talk about right now. But if you consider the countries that feed the German manufacturing scene, Poland, Austria, they're absolutely debilitated. The fact that she's going to continue to raise interest rates into this environment because the sanctions were toothless. I mean, there's a certain sad note to that, a very sad note to that. She's chasing after an inflation that's sticky by politicians' design.
And again, I just find it, I'm incredulous that it wasn't foreseen, that this would be a result of that. And obviously, I think it's actually hurt us enormously. I think England having Brexited out of Europe is probably an advantage for us. I know probably not everyone will agree, but actually, I think I don't see any kind of problems from that, other than we've got a lot of migrants coming in, et cetera, literally that we cannot even house. I mean, literally. But again, that's Europe's the residual European laws that say that you cannot refuse somebody entrance. But I think Brexit has done us a power of good, and I think that. But I think what I was kind of leading to was the World Economic Forum. Now, obviously, there's a lot of conspiracy theories, et cetera, et cetera. I'm not going into that. What I'm saying is that when we hear the same mantra, whether it's Biden, whether it's our government here, European governments, all saying build back better. But what they're saying is, but then when you look at what's going on, you almost get the sense that you have to break something to build it back better, in the way the World Economic Forum is dictating. Well, just your thoughts on that, Danielle.
Well, I'm sitting in Indiana, but I am a Texan, and I have very little tolerance or appreciation for short-sighted green policy. That's the beginning and the end of my answer. So you're watching Ford Motor, for example, just one company drive itself into the ground, trying to become eventually productive and efficient and profitable for electric vehicles, which leave a larger carbon footprint than an internal combustion engine does. So I think it's a bunch of hooey. And for me, the biggest tragedy here is that nobody actually wants to discuss the facts. They just want to stick to the narrative. They don't want to talk about the damage that EV production does globally. They just want to get there at what may, whatever the cost is. I mean, think about it. Paris is sitting on the largest shale production capacity on the planet and suffering. So there's just certain irony. I think global historians will look back on this chapter and shake their heads at the hubris of people who had grand designs that ended up being so debilitating long-term economically.
I guess that really, after, I guess everyone's got on high alert after the pandemic, which I'm not sure that we couldn't have dealt with that a hell of a lot better. And it just seemed to be good control going to the wrong places, and really who's serving who at this point. But in fact, if you look at this country, the WhatsApp messages that were kind of unloaded from the various people controlling the pandemic, were laughing at the people, laughing at us, and saying, well, let's try this. Let's see how they react to this, and yet they were partying. There was no masks going on. There was nothing. So, and yet we were locked down. We were unable to see your relatives in an old person's home, even if they were dying. And yet so then now, after we sort of come out of this and everyone's on high alert, hang on, that ain't happening again. we're going to really question this. Suddenly you've got this green agenda. And I guess what I'm leading to is this ESG. ESG has been so highly politicized. And I think it was Larry Fink recently started pulling back, I believe. He was evidencing so many redemptions from his ESG investments that he started pulling back. Jerry, probably the last question we've got time for, but let me see, what do you think? What's going on here?
At the risk of being a broken record, actions speak louder than words. And the fact that Vanguard itself pulled back, it wasn't somebody, my home state of Florida, my home state of Texas, the state of Florida, no huge surprise there. But when the money started flowing out, and then when Vanguard said, we're not going to play this game. We're not going to bleed assets for some agenda that's unproven and probably, again, bad in the end. Look, I'm all over everybody deserving their fair shot. I'm a successful woman in finance. So, but should certain things be absolutely forced upon people? I mean, the irony is right now is that diversity officers are being fired right and left because in times of global recession, when companies look at cost centers versus profit centers, they're getting rid of cost centers. And again, there are certain types of agendas that can be pursued when times are good. And when reality sets in, then you see a reversal of quite a few of them. That's where we are today. That's the reality that Larry Fink is dealing with. And rightly so.
Interesting. Yeah, no, that's interesting. So obviously, from our perspective, we don't so much view gold as increasing in value or silver increasing in value or sort of the precious metals increasing in value. It's just taking more and more dollars, pounds, euros, etc., to buy the same ounce. 5,000 years of back testing tells us it hasn't changed in price, which is kind of cool. So I think what we're looking at is first and foremost wealth preservation. What's the point of having a bucket with a hole in it if you keep pouring more stuff in it? So essentially, should people, and in your view, should people have gold and silver in their portfolios?
Oh, I believe I've always been of that mindset.
Yes.
If you're in inflationary times, then you're losing buying power. If you're in deflationary times, then your capital appreciation is hurting your holdings. So it's one or the other that should tell you that a good portion of whatever you're comfortable with of your portfolio should indeed be in precious metals. That's, again, it's the fallacy that gold does well only in inflationary environments is just that. It's a fallacy because what you can lose in terms of capital depreciation can well outweigh what you might have lost in an inflationary environment. And people need to understand that distinction. Sometimes I feel that the gold bugs of the world are solely focused on inflation being the boogeyman. I'll tell you what, when the great financial crisis hit, we know what asset class performed well after the margin calls had been made and post margin call. And that's important to bear in mind, right? That a lot of people will be, oh, gold fell initially. Well, yeah, you sell what you can when you have to satisfy those margin calls.
Well, I think I always sell. If somebody's trading a 10-minute chart and moans about it, go find something else to play with, because as you say, you have to step back and look at the bigger picture and go back to what the dollar is worth in 1913 and look at its worth in purchasing power now and then weigh up other asset classes against it. And certainly gold is one of those few asset classes that have really stood the test of time, as it will continue to do. Clearly.
As I say, with shredded dollars behind me. So yes.
I think that's great. I wouldn't buy one of those.
Well, they're shredded.
And I think I know I'm conscious of your time. So every single central bank around the world has been openly, as we said, purchasing gold. It's not a theory; it's a fact. We also know we've got empirical evidence, certainly as wholesalers, that there's a lot of monetary gold actually that's unreported, going into central banks. Now, each central bank has a gold revaluation account. So right now, Treasury gold's worth priced at $42. To revalue gold, should there be a necessity, should all hell break loose, should there be a necessity to revalue gold, it's as simple as selling it and buying it back. Done. That would really create a hell of a lot of cash into the system. And if one does it, they probably all do it. So any thoughts on that? And I'll let you go after this.
So I've heard this as a potential strategy.
Mm-hmm.
You're increasingly hearing it.
Mm-hmm.
It worries me to think that that only one country would be able to do it.
Mm-hmm.
And then you would be caught on the outs if you weren't the first mover.
Mm-hmm. So if one does it, they all have to do it.
Right. But then you get down to the brass tacks of demand and supply.
Which could put the price at $6,000. It could put the price, whatever it is. If it was truly a supply-demand market, if it was really supply-demand, then a gold price will emerge, whatever that is. Maybe it's a catch-up price. I'm not saying it's going to go to $6,000. I'm not saying it's going to go anywhere near that. But what I'm saying is, should that happen, then we'll see a real gold price emerge. I think we've had years and years, 50 years of COMEX. COMEX was instigated 50 years ago after Nixon took gold off the dollar peg, and 2 years later he had to put it on the COMEX and dilute it with paper. And you protect, then that way you're not, people were not able to exchange their dollars for gold because you suddenly had this dilutive power. But I think that's ending now, simply as when Basel III came in and valued gold as a first-tier asset. And we know from this side of the pond, whereas before the 1st of January, liquidity providers could easily leverage their positions. But now they're not able to because you have to have an ounce for every ounce, a ton for every ton. And whereas in March 2020, we saw when we did have when there was a shortage of bullion for different reasons because of COVID, all the refiners were shut. And suddenly they had the liquidity providers there who were not physically backed. And I think this is one of the reasons Basel III was actually forced into motion, was suddenly we've got these liquidity providers using COMEX as a hedge, but not having the physical anyway. And suddenly it goes bid only and there's a $100 spread to try and get out of your position. And that was with the banks coming in and getting bailed out. I mean, HSBC got bailed out by $200 billion, and so on and so forth. But I think now it's a different situation because liquidity providers do have the physical, and it is a first-tier asset. So it should be interesting. I think this year is an interesting year for gold, and I think it's something that we're all watching because I think it changes this 50-year game.
Well, most would agree that that game-changing moment was needed anyways. So here we are.
Danielle, thank you so much for being so gracious to give us this valuable hour. I'm going to ask people to replay some of the stuff you've said. Gives me a whole new perspective on what I'm thinking about. Mm-hmm. On Powell, for one, various other things. So I just like things to be put in, all the pieces of the jigsaw to come together. You've really helped us with that today. And we've cast that net out that bit wider than we could have ourselves. But thank you so much for joining us.
Well, I appreciate your time as well. It's been very enlightening. Thank you.
Thank you, Andrew Maguire and Danielle DiMartino Booth, for another fascinating conversation. And to all of our Live from the Vault community, remember, buy physical. Make sure it's 1-to-1 and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. Now, please help keep spreading the word about this channel by hitting that like button right there. You can see it. And then sharing this information, and also make sure you're subscribed if you haven't already done so. And if you want to be notified in real time as each episode goes live, just look for that bell, click on it, and we'll do just that. And with that, we'll see you next time right here on Live from the Vault. See you then.